Market structure and market structure breaks. In today's video, I will end the internal discussion that has been going on about valid and invalid market structure breaks and on how to identify market structure. In today's video, if you watch the entire video, you will finally understand when a market structure break or a break of structure, whatever you want to call it, is valid and when it is invalid. And when it's invalid, how it's actually engineering liquidity at certain places that we can then use to identify certain entry points. Now let's start off with the basics, in which we obviously have an uptrend of market structure and a downtrend of market structure. I think everyone can identify the uptrend and downtrend. Now the most important thing is that within this uptrend, right, you have all of these what I call fake break of structures. Now I might be wondering, okay, but Jip, this is a valid break of structure, right? Because we are pushing above this high and we are opening and closing candles above that high. Why is it not a valid break of structure? And this is where most of the people are making huge mistakes. If you were to ask me, you have to realize that a market structure break is only valid if we either break a significant high or a significant low. Now a high becomes significant when the high that we break brings us to a fresh low compared to the low that brings us to that high. Because this high over here brings us to a lower low compared to this low that brought us to that high, it all of a sudden becomes a significant high to break. Now if this is, for example, on the 4-hourly time frame, you want to see a push above, and then you need a candle open and a candle close above the significant high to call it a valid break of structure. So a wick above isn't sufficient. A candle close above isn't sufficient. We need a candle open and a candle close above that significant high that brought us to this lower low compared to this low that brought us to that high in order to call it a valid break of structure. Now if this happens, then you have a confirmed shift in structure and you have yourself a trend reversal, and then we can continue to the upside. But in that case, if this happens again, right, in which the high that we break brings us to a higher low and not to a lower low compared to this low that brought us to that high, this over here, ladies and gentlemen, is a fake break of structure. Once again, it's a fake break of structure because the high did not bring us to a lower low compared to this low that brought us to that high. So it's not a significant high to break and not a break that you can use in order to identify a potential trading idea. What a break like this can do is trap people into thinking that we are looking at a valid break of structure. Now get into the mind of the retail traders. If they think that they see a push towards the upside with some momentum and we open and close candles above this high, they think that they have a valid break of structure. So what will they do? They will start looking for longs over here. And where are they placing their stop loss? Beneath the low that started the impulse that gave them the, in their opinion, valid break of structure. So what basically happens because of these fake break of structures, there's lots of stops being placed beneath these weak lows over here. And basically the stops are engineering lots of liquidity beneath this low. Now we know that as traders always want to enter where other people are getting stopped out. Now this is one of my favorite entry models, in which we have a downtrend, mitigate, for example, a high time frame fair value gap over here, or maybe a high time frame liquidity pool, then confirm the trend shift over here with a valid break of structure, then put in a fake break of structure that engineers liquidity over here, like I just explained, and then we use that engineered liquidity to identify our area where we are then interested in potentially longing the price of Bitcoin or any other altcoin with our invalidation beneath the low that started this impulse that gave us this valid break of structure as our invalidation, and then we target high time frame buys and liquidity. But it all starts with a downtrend or an uptrend in which we patiently wait for a high probability and valid break of structure. A valid break of structure means that we need to open and close candles above a significant high that brings us to a lower low compared to the low that brought us to that high, or we need to open and close a candle beneath a significant low that brought us to a high, right? But not that brought us to a higher high compared to the high that brought us to that low, I must say. All right, so you simply invert the chart, and then once again you can see this is a valid break of structure to the downside, right? Let's say on the other hand, price action would have been like this. This is a fake break of structure. Why? Because this low that we break through did not bring us to a higher high compared to the high that brought us to that low, making it an insignificant low to break and an insignificant break of structure. And that is something that you have to keep in mind in order to understand not only market structure, but more importantly, in order to understand a potential flip in market structure. Because if you understand the flip in market structure, you are able to identify early entry point with a high RR and a high probability setup. So start with understanding market structures, start with understanding fake break of structures and valid break of structures, and then as a next step, start understanding how these fake break of structures are inducing people into opening up invalid longs and invalid shorts, and try to figure out where the people that open up these invalid long and shorts, where they are going to place their stop loss. Because we know that as traders, we always want to enter where retail traders are getting stopped out. Now, retail traders, they identify fake breakup structures as valid breakup structures. So once you stop doing that, you are already way ahead of the retail traders. But if you want to be one more step ahead of the retail traders, you have to identify the first fake breakup structure. But then second of all, you have to identify where the people that long or short because of that fake breakup structure are going to place their stop in order to know where the liquidity on the chart is being engineered, in order to know where you have to enter in order to get a high probability trade setup. After I have explained the theory of this, we are obviously also going to dive into a real life example of a high probability trade setup on Solana that happened yesterday based off just this market structure and based off just these fake breakup structures to engineer liquidity. And I'm going to show you guys how you could have used this market structure and liquidity to get to a high probability trade setup. So what we can see over here on the Solana chart, guys, yesterday is that we had this market structure to the upside, right? First, we had a market structure over here to the downside. Then we have this low, a high. The high brought us to a lower low compared to this low that brought us to that high, making that high a significant high to break. Market structure break over here was confirmed. After we confirmed the market structure, enter a local uptrend over here, where we are constantly putting in higher highs and higher lows. But what are these higher highs and higher lows doing? They are indeed putting in fake break of structure. So we have a fake break of structure over here, another fake break of structure over here, and another fake break of structure over here. Why are these fake break of structures? Because the highs that we break through over here did not bring us to lower lows compared to the lows that brought us to those highs, making it insignificant highs to break and therefore a fake break of structure. So these fake break of structures were engineering liquidity beneath the lows that started the impulses of those fake break of structure. Now look at how the final fake break of structure engineered liquidity beneath this low. It did not only engineer liquidity beneath that low, but beneath that low we had a high probability bullish order block. And look how the price took out that low, right? Why was there liquidity there? Because of this consolidation. People started longing the breakout with their stop loss beneath that low, right? Thinking it was a valid break of structure. We take the stops of the early and greedy long positions over here, tap into that bullish order block. That's where we could have had our entry point with our invalidation beneath a bullish order block, and then target the buy side liquidity that is resting above these highs over here for Solana, offering a beautiful 2.17 RR trade. And this trade is based just off market structure, based just off fake break of structures, and based just off liquidity. Now, if you understand these three concepts, and if you start understanding ranges besides these concepts, you are well ahead of the retail traders and you are well ahead on becoming a profitable trader yourself.